Welcome, everyone. Let's dive right into the world of tokenized debt instruments. These are essentially digital representations of traditional financial products like bonds and loans, but on a blockchain.
Yeah, that's right. So, essentially, we're talking about using blockchain to transform regular bonds or loans into digital tokens.
Exactly. It's like um, instead of holding a physical or paper certificate, you have a digital token that stands in
Mm-hmm.
for that investment. And the core idea is to use blockchain technology to enhance efficiency and security.
That definitely sounds innovative. What are some of the key benefits that come with this kind of technology?
Well, for starters, tokenized debt instruments can really ramp up liquidity. Because you can break down these large debts into smaller tradable units, it opens the market up to more investors, even retail ones. It's
Yeah,
like getting a
exactly.
slice of a huge pie instead of needing to buy the whole pie.
And it's not just about liquidity, right? There's also efficiency. The use of smart contracts automates processes like interest payments and settlements.
Right. Smart contracts streamline everything, cutting out a lot of the intermediaries that usually add cost and delay. It's kind of like having an automatic financial manager handling all those payments, which, yeah, really minimizes errors.
So, by automating these processes, transaction costs drop and operations speed up. Now I'm curious, how does fractional ownership play into this?
Fractional ownership is one of the most exciting aspects. Since debt is tokenized, an investor can purchase just a part of a bond or loan, reducing the barrier
Absolutely.
for entry. This opens up previously exclusive markets to a much wider range of investors.
That democratization of investment is pretty cool, but surely there must be challenges associated with tokenized debt as well.
Certainly, there are challenges. One of the big ones is regulatory uncertainty. Different jurisdictions have varying rules around blockchain based assets, making it tough for issuers to navigate. There's also a
Mhm.
need for standardization and legal recognition for these instruments.
Now, if I may respectfully challenge a bit here, wouldn't you say that despite these challenges, regulatory frameworks are slowly catching up?
Good point, but while that's true, the pace of development in regulation isn't uniform across regions, and there's still a lot of fragmentation. This inconsistency can create hurdles, especially for cross border transactions.
Right, I see your point. Speaking of, what about the technological risks? When you're dealing with smart contracts, isn't there still a danger of vulnerabilities like coding errors or hacks?
Yes, absolutely. Smart contracts are only as secure as the code behind them. Coding errors can lead to substantial financial losses, and while blockchain is inherently secure thanks to its cryptographic nature, no system is completely immune to risk.
That's fair. And then there's market maturity too. Tokenized debt is still somewhat in its infancy when it comes to traditional financial institutions, right?
Exactly. The adoption by established institutions is growing, but overall trading volumes in secondary markets remain modest. That means liquidity, although improved compared to traditional systems, might not always be as robust as one would like.
Yeah, I can see that. Let's shift gears a bit and talk about the different types of tokenized debt instruments. What are we looking at here?
We can mainly break them down into a few categories: tokenized bonds, tokenized loans, digital promissory notes, and crypto backed debt securities. Each of these leverages blockchain in slightly different ways.
That's interesting. So, tokenized bonds are just regular bonds turned into digital tokens, and tokenized loans?
Tokenized loans allow multiple lenders to fund a single borrower, which brings in the idea of fractional ownership again. It allows smaller investments and, thus, spreads the risk while still enabling potential profit sharing among lenders.
Yeah, that's pretty clever. And what about digital promissory notes and crypto backed debt securities?
Digital promissory notes involve creating digital contracts where promises to repay are recorded on blockchain. Very streamlined, no paper trail needed. Crypto backed debt securities, on the other hand, are hybrid instruments where the debt is secured by cryptocurrency
Exactly, it's like
assets.
merging the best of both worlds. Now, how exactly do these tokenized debt instruments work step by step?
The process kicks off with asset digitization. A traditional debt instrument is chosen, and then a blockchain based digital version is created. After that, a smart contract is deployed to encode all the terms, including interest rate, repayment schedule, and maturity date.
Yeah, exactly. Following that, you have token creation and distribution, right?
That's right. The debt is split into smaller, tradable tokens and made available to investors. Platforms like Hadron by Tether, for example, facilitate this process by connecting issuers with their potential investors.
That's a neat solution. And after issuance, smart contracts handle trading, interest payments, and everything else automatically. Is that correct?
Yes, indeed. The trading and management processes are streamlined for efficiency, with custody secured in digital wallets and transparent ownership records logged on the blockchain.
Absolutely clear and concise. One thing I'm really curious about is redemption. How does the redemption process work for these debt tokens at maturity?
Redemption is pretty straightforward thanks to smart contracts. When a tokenized debt instrument reaches maturity, the issuer repays the principal along with the final interest payments. Depending on the contract, this can be executed in fiat, cryptocurrency, or other digital assets.
Exactly. So the automation here really minimizes delays and disputes. And all of this is recorded on a blockchain, which ensures absolute transparency, right?
Right on the money. Every transaction, including interest payments and principal redemption, is logged securely on an immutable ledger. This transparency is a huge trust booster for investors.
No room for shady business there. It sounds like tokenized debt is part of a broader trend of tokenizing traditional financial assets. What are your thoughts on that trend?
It's a significant trend indeed. Beyond just debt, we're talking about real estate, stocks, and other securities undergoing tokenization. It's transforming how we trade and manage assets globally.
Absolutely. It's revolutionizing accessibility and efficiency. There's also that interesting historical note about the World Bank's Bondi in 2018 being the first fully managed blockchain bond, isn't there?
Yes, that's a notable milestone. The Bondi set the stage for what tokenized debt could become, demonstrating blockchain's potential in modernizing financial markets.
Yeah, that was a real game changer. And then we have market forecasts too, right? There are some pretty high expectations for the asset tokenization market in the near future.
Exactly. Projections vary widely, from McKinsey's somewhat conservative estimate of under $2 trillion by 2030 to Bernstein and Citi forecasting figures as high as $5 trillion even by 2028 or 2030.
That's a wide range of estimates. Given these projections, are there any overarching concerns from investors despite such promising growth?
Absolutely. Investors need to be aware of risks such as market liquidity challenges and the potential for technological issues like smart contract vulnerabilities. Plus, regulatory hurdles continue to cast a shadow over the market.
Right, and that risk factor is something every investor should seriously consider. With challenges come opportunities, though, especially in increasing accessibility through fractional ownership and automated processes.
Right, it's a trade-off. The potential for a more efficient, democratized financial system is huge, but balancing innovation with security and legal compliance remains the key.
Exactly. A bit of cautious optimism is the way forward. It's really fascinating how blockchain has nudged conventional banking into creating these novel tokenized products. It reminds me of how traditional systems are being reimagined for the digital age.
Yes, it's a complete paradigm shift. Tokenized debt instruments, while still maturing, already offer a glimpse into a future where financial assets are more accessible, efficient, and secure.
Absolutely, and it's exciting to see what innovations lie ahead. I do wonder if the benefits will eventually outweigh the challenges, especially as more institutions get involved.
I believe so. As the ecosystem matures and regulatory frameworks catch up, the efficiencies and safety provided by blockchain will likely tip the scales in favor of tokenization.
I share that sentiment. In summary, tokenized debt instruments are transforming how traditional financial products are managed, traded, and experienced. With benefits like improved liquidity, cost efficiency, and enhanced transparency, they're reshaping the financial landscape.
Absolutely. While challenges remain, regulatory, technological, and market-based, the evolution of tokenized debt is definitely a trend to watch as it promises to redefine modern finance.
Right, it's a revolution in the making. Thanks for that deep dive. I look forward to seeing how these innovative financial instruments continue to develop.